Sequencing risk is effectively says that the manner in which returns are achieved matter. And what that means is if, for instance, on the one hand, you put one lot of money in today and you never touch it for 20 years, then it doesn't matter if the compound return is, say, 8%. It doesn't matter if it was earned 8% per year or in lumps, because the same lot of money is earning that return over that period of time. The reality is very few people have that experience. In reality, people put money in over time and take money out over time. And in that environment, how the market moves during those periods is very important. If the markets drop dramatically very close to when you start taking money out, that is the point in time when you've got a lot of money invested. So a big drop there has a far bigger impact than if it dropped tremendously right at the beginning because you didn't have much money invested. So it's very hard because you cannot control how you age and when you need to put money, when you need to take money out, and you cannot control what the market does specifically, which is the big issue of sequencing risk. The solution that we aim to provide is if we can smooth the return profile, if we can make it more consistent, more reliable, more positive more often, then it matters less when you invest and when you take your money out. Inevitably, the biggest surprise will be one that I don't expect. But in terms of what I think could happen that would be a surprise compared to what the market's currently thinking, I don't expect the US growth to turn down. But if that did happen, that would be a very big negative surprise and would impact markets, I think, considerably, because I think a big chunk of the market rally we've had has been the reacceleration of the US, and the European situation has been put on the back burner from a cliff risk point of view, which would be the other surprise, is if something out of Europe comes out that tends to be of a cataclysmic nature. So I think something negative US growth or sovereign issue in Europe are the most likely places we might get negative surprises. In a low yield environment, the appeal of high yielding or yield driven assets is very appealing, and I think that potentially has gone too far. So companies in utilities, telecoms, blue chip dividend paying companies, I think there's a fair chance that the valuation of those companies has been driven to a level that's probably not supported by other factors of those businesses. We still think it's better to put your capital with a good company, with a good management team, in an industry that's growing. The challenge is how to buy that at a price that isn't appreciated by everybody else. And the way to attack that is the best defense we have against that is to find them when they're out of favor, when they're going through a cyclical downturn, or when they have an issue that we think most people are overreacting to short-term issues and not looking for the forest for the trees. And that's the way to address that, but I still think that's the right way to invest in the market. I think historically, and by that I mean the last 30, 40 years up until 3-4 years ago, what politicians did, provided they didn't move things too much in most of the developed markets, it didn't really matter from an investment point of view. You could still let investment markets and efficient markets somehow dictate where you should go or what the investment outcomes would be. But most recently, post the GFCs particularly, central banks and indirectly governments have taken renewed interest in asset markets. And to an extent, they're trying to control the fixed income market by keeping yields low for various reasons. One's borrowing costs, one's concerns about sovereign viability in Europe. And they're also trying to keep equity markets high because there's wealth effect benefits and there's all kinds of benefits that flow through from a positive equity market. And they've taken renewed interest in the movement of those asset classes and have tremendous tools in the toolbox to affect that change. And we've seen that already in quantitative easing in 3 of the major economies of the world, Japan, Europe, and the US. And that is something that I don't think investors should ignore or fight against, and should appreciate that the rules have changed somewhat. A few things. One of the good things about Europe is they're very inefficient. If they were very efficient getting older and in debt, you would kind of worry, what can they improve on? They're very inefficient in their labour markets, in their product markets, in their regulations, the inefficiencies there. So some of what the benefits are having from the austerity, while there's a lot of negatives, some of the benefits are opening up those inefficiencies. And if those flow on, I think you could see, and it might not be this year and it might not be next year, but it might be 3 or 4 years or hence, you might see a new dynamism come out of Ireland, Spain, and actually reignite those economies. So that's one level of hope that can actually bring a new growth engine to the world if we can sort of keep that process going. The second thing is the US economy can just kick on higher. It started getting some traction, but it's still slightly above the zero line. Housing market's turning around. The banks are probably the most well-funded, best capitalized than they've ever been. So you've got a strong banking sector, you've got a recovering housing market, you've got some reindustrialization happening from nat gas, from competitiveness being driven by Chinese labor costs going up. So US is becoming more competitive. So you might get the US just kicking into a gear where some of those reservations about spending and capex and investment get taken off the table, and that free cash flow that's available in the US market gets used, and that could drive US growth higher than has been expected, and that's a very exciting potential outcome. Our process is not volatility driven. Our process is about, as I mentioned, buying good companies at the right price in the right way. Doing that in any environment we think pays off. In volatile environments, because our process does take advantage of increases in volatility, we think we get an extra benefit. But we don't think that extra benefit becomes a negative in low volatility environments. And the last few years' returns have demonstrated that, because volatility has actually been quite low. Companies that we're investing in are very selectively chosen. So the healthcare industry is a very big industry globally, US in particular. There's a lot of regulation going on, there's patent risk, there's a lot of issues going on, and to just buy in general that sector would, I think, be quite a dangerous proposition. But if you can find those companies that are well placed to take advantage of the changes in legislation, have the product life cycles that don't have patent risk as much, have the valuations that account for these unexpected or uncertain outcomes, I think that is a very powerful potential investment proposition. I think you've got to be pragmatic, look beyond the most recent headlines, and make sure that whatever you want over time, you're not panicking in the short term and anchoring into short-term market movements, because I think that's the most common mistake people make. If markets are very strong, they suddenly want to be in them. If they're very weak, they want to get out of. You've got to take a longer perspective. Post the financial crisis, a lot of opportunities presented themselves, particularly in the places that people were most scared of. Because as a contrarian investor, you generally look for opportunities where most people are scared of. So when we looked at the playing field after the GFC, we saw that, and this is some months and even years after the GFC, it's not directly afterwards, we saw that regulation had improved, a lot of the toxic assets had been removed, the capitalization and deposit ratios of the banks had improved, their net interest margins had gone up because the quality of loans they could make were better and the terms of against their borrowers were improved as well. So when you put that all together, you found yourself with an industry that was earning supernormal profits to an extent, with above average collateral because house prices were now quite low, at valuations that assumed that those companies were almost on the verge of bankruptcy. And none of that made sense when you put this all together for a select group of companies. So not all of them were fine, but the ones we invested at, Wells Fargo, American Express, and at a later stage actually Bank of America. Key part of our investment process and stock selection is we can only have comfort in companies that we believe have long-term relevancy. They're relevant to their stakeholders, their customers, and even to the shareholders. And a few industries have products that lose their relevancy too quickly. And we cannot have confidence that they can recreate that magic that once was there. And the IT sector, software development, those sectors in particular, you're only as good as your most recent product. And I think Apple is a good example of that. Just less recently than that, Nokia, Motorola, that they were industry titans, and then they just missed out on the revolutionary life cycle of their product. We don't think we bring a particular skill set into predicting future product innovations, and for that reason we think the risk is elevated in trying to do so. Trying to balance off the risk and return of those. A favourite one, and this is not a prediction over any specific short-term period, but it's over time we think will compound well, would be Canadian Natural Resources. We think they've got a tremendous oil reserve base in Canada that can effectively convert oil from $35 cost price to $100 selling price. And we think they can do that for many, many years to come. And that share's trading on 10, 11 times earnings. So we believe that's a very good company to own. Second share we like is Coach. They're a mid-market luxury handbag and accessories provider, predominantly in the US, 70% in the US, 20-odd% in emerging markets. The emerging markets piece growing at greater than 20% a year. The US piece, which they dominate, they're about 30% of the luxury goods market in the US, which is about 10% higher than LVMH, so it just shows how strong they are. That's their cash cow, and they're using that excess cash flow to grow into China and to other emerging markets. That business trades on 10, 11 times earnings, with a very strong dividend yield, growing dividend, buying back 3-4% of their shares a year. The combination of that valuation, that cash flow allocation, and that safer market segment in the US and growth opportunity in emerging markets is very appealing to us. The next share, which is a recent addition to the portfolio, is United Healthcare. They're a Dow component, a very large company, about 150 billion of turnover. And while the healthcare sector scares many people because there's a tremendous amount of regulation, there's Obamacare packages and regulations coming into play 2014 onwards, and that's driven a valuation reduction in the company. They trade on 10 times earnings, their cash flows are approximately 10% of their market cap. Once again, they're also buying back shares. The key thing we like about the business, though, which we think is underappreciated, is that they're not just in one segment of the managed healthcare sector. They're in the pharmaceutical benefits management place. They're in the IT segment in terms of servicing providers to their clients. They provide different healthcare packages across all segments of the market. And our view is no matter how these regulations change, the total sum of money isn't going to drop. And United Health is very well placed with its multitude of products and sector exposures to participate in that. That sheriff are three central banks, the ECB, the US, Ben Bernanke, and most recently Japan. And they are trying to support asset prices by printing money. They may not say it in those terms, but it's quite obvious that's the implication. And while they're trying to support asset prices, they're trying to support asset prices on the equity side and suppress fixed income yields on the other end. And they're doing that twofold. They know there's too much debt in the system, so the one way to reduce debt is keep yields low and monetize it. And they're doing that. The other way of trying to promote some economic growth and inflate asset prices, because one way of deleveraging is inflate asset prices, is to print money, and because equities are a monetary asset and equities look more appealing in a low yield environment. So the monetary processes being done by those central banks is very supportive of equity markets and actually provide, in our view, a relatively high floor for those prices. And we think when we say new sheriff in town, you have to appreciate that the paradigm has now shifted and it's not a purely rational economic forces at play here. There are some intermeddling government forces happening. China has come off a period of very strong growth and has been slowing down of recent, and we think that trend's going to continue. They've tried a lot of tricks in terms of mercantilism, trying to keep their currency too low, keep interest rates too low, so providing cheap bank deposits to corporates and government-owned institutions that spend that money on infrastructure. We think that game is coming to an end and they have to rebalance their economy into more consumption-driven. The problem with that is consumption is a very small portion of the economy, about 30% compared to most Western economies of about 70%. So the growth there, just mathematically, is going to make the growth in the total economy lower because the part that's growing is small and the part that's growing at a far lower rate or even potentially shrinking is the bigger part. And that combination, we think, presents significant challenges to Chinese growth.